3 stocks at their 52-week low. We're going to go through them right now. The great thing about 52-week low stocks is it's a great place to start looking for value. The reason being, they're down off their major lows, 52-week lows. Now, does it mean that just because they're at a 52-week low that it's a good deal? Don't fall for that crap. Don't fall for the, oh my gosh, it's something. If I told you right now that your house that you bought for $400,000, if I put the price at $3 million and then dropped it to $1.5 million, it doesn't make it a good deal, right? So the same thing with stocks. So in this video, I want to cover these 3 stocks. We're going to do more high level about it. We're going to go through some analyst estimates, some 8 pillars on them, and we're going to look at the news as to why they are the way they are, why they might be falling, okay? So I want you to pay attention to this entire video because whether you're a beginner or more advanced investor or somewhere in between, there is something for you in this video. And it might be confusing to start, but that's okay. It was extremely confusing for me to start, but you're at least in the top threshold of people who cares about learning about investing, and that's why you're watching this channel. So watch all the way through. The further we get along, the more you're going to learn. First stock, Dollar Tree, DLTR. Let's pull it up right here. It is down year to date 21%. 52-week low of 120.33 hit today. All-time high, April 21st, 2022. Just a year and a half ago, not even a year and a half ago. And the stock is down over 30% from its all-time high. All right, so quick metrics to look at. PE is 20, which isn't terribly high, but not low. 5-year PE is 34. Okay, means take all the last 5 years of earnings, divide it into the current market cap, you get 34. Not bad. Now, one thing that does concern me, their average profit margin in the last 5 years has been 2.8, and last year it was 4.2. That's 50% higher than normal. So this 20 PE, which is driven by this profit margin, might be a fluke. Okay, a couple other things. Last year's net free cash flow was $520 million. Last year's net income, though, was $1.2 billion. I don't like that difference. But guess what? The last 5 years average free cash flow was $830 million, and the 5-year average was $720. That makes me feel better. Okay, so this might have just been a fluke year. They maybe had some special income event that occurred that increased their profit, but not their cash flow. Okay, not bad. Now, one thing I'm not a huge fan of, we just did a video on Dollar General that's coming out in a few days. The Dollar General 5-year return on invested capital is 11.5%. This is 7.8. That means when they invest the money into their business, they're only getting a 7.8% return on that money. You want to find companies with it to be higher. The market average is 9 or 10%. We want companies higher than that. If they're able to invest the money in the business at higher rates of return, they're going to be able to build their profit much faster. That's what we want. That's why you're willing to pay a premium for the company. So if you don't have that, why the heck am I paying this premium? All right, let's go check out the 8 pillars on this company. And remember, guys, if you're part of our community, you can customize your pillars up to 12 different pillars, not just 8. But right here, we have 5 X's and 3 checks. Okay, they bought back some shares. Super. Net income growth, revenue growth, cash flow is down a little bit. A lot. I mean, well, it's actually kind of a lot. But their metrics are high in terms of 5-year PE and 5-year price to free cash flow. I'm not as worried about their debt because they're a retail place. So they're going to have a lot of retail debt, leases and things like that. So that doesn't worry me as much. But I don't like this return on invested capital. I got to discount the company. I can't pay a big premium for the company when they're not investing the money at high rates of return. That is a concern of mine. Let's see what analysts think about the company. Okay, so they expected to make $748 up until March of 2023, earlier this year, going to $1241 in 2028. All right, so some pretty decent growth there on earnings per share. Revenue, slow and steady, mid-single digit revenue growth. Not bad, not great, not insane. Dollar General has 18,000 stores. Dollar Tree has a total of 16,300 units. Pretty good. Most items are priced around $1.25. Gross profit, 30.2%. Pretty much in line with Dollar General. All right, so what's the price to pay for Dollar Tree? Guys, I'm just going to pull up our stock analyzer that we did on this company recently. I can go to the history on this, type in Dollar Tree. We did it on August 28th, 2023. But something I want to announce first before we go a little bit further. Guys, I got an email a few weeks ago from one of our most active subscribers, and his comment to me was, Paul, love your software. It's changed my life. But he had one recommendation for me. He said, before you offered the $7 for 7 days, I was not signing up for your software. I didn't want to risk 30 or 40 bucks a month. And he said to me, I think you're missing out on some great users like me. He said, Paul, go even further. Make it 7 days for free, full access. He goes, I think people will fall in love with your software and give them a shot to use it and fall in love with it. So I said, let's give it a shot. Let's try it. So guys, click the link below or go to everythingmoney.com/signup. And it's 7 days fully for free, full access, all community, all tools, everything you see here, full access. 7 days for free. You cannot beat that. Absolutely cannot. So I'm going to pull up Dollar Tree from August 28th. Here are my assumptions. I did 3, 5, and 7% revenue growth as my low, middle, and high. Okay. Inflation, a little better as they open more stores, etc. Profit margin. So I want to focus around this 5 and 10-year number. So I did 3, 3.5, and 4%. And I did the same thing for free cash flow since they're pretty much the same in the 5 and 10-year number. And remember I was talking about before about that? I like the fact that the free cash flow and profit margin are the same over 5 and 10 years. Actually, free cash flow is better over the last 5 years. Now, for PE, the current PE is 20. The current price of free cash flow is 47. This is asking you, what PE do you think it should sell for in 10 years? A low, middle, and high. Now, remember, the ROIC is declining. It was 10% over the last 10 years, 7.8 over the last 5 years, 6.1 last year. So I want to account for that. And it's not going to be a fast-growing business. So I actually put 12, 14, and 16 for both future PE and future price of free cash flow. All right? Because, again, it's not growing fast, and it's not going to have a high ROIC. So the only way to really get extra value to investors is paying dividends or buying back shares. All right? And they have to do that when it's cheap. Desired annual return, my final one. Guys, I want to sit there, and I want to give my margin of safety. I did 11, 13, and 15%. I hit the analyze button, and I had the stock between 50 on the low side, 75 in the high, 60 in the middle. But I'm not terribly excited on the company, so I actually put on my watch list at 50 bucks. All right, so I'm going to get notified when that happens. Stock number 2, Planet Fitness. The reason they're down so much, they're down 38% year to date, but in the last week, they're down 17% because their CEO just left. Now, their CEO's father, I think they bought the company when it was small locations. I actually bought a house from him in Akron, Ohio. That was the house, was the Planet Fitness people. All right, so Planet Fitness down a lot. Year to date, 38%, all-time high of $100 on November 5th, 2021. It's down to 48 bucks. So it's down over 50% from its all-time high less than 2 years ago. Really high return on invested capital, 18.6%. Terrible free cash flow. Barf City. Ugh, I don't like this. Good margins, 58% gross margin, 10 to 12% bottom line margin, but I hate these metrics. Okay, well, let's go see what's going on with the 8 pillars. Boy, high PE, high price of free cash flow. Guys, let's look at their net income. Let's see what they've made over the last few years. Yeah, guys, I don't think this company's worth much. They're fluke years recently, besides they made 105 in June, the year ending June 2019. They made 124 in the year ending June 2023. Other than that, their best ever was 62 million. That was the previous year. I don't think this justifies a $4 billion company. You got to look at stabilized earnings. I mean, their revenue is skyrocketing, and the question is this stable revenue? Is this a permanent plateau? If it is, then I'm probably wrong. But the permanent plateau, even at a $100 million average, you're still talking about a $4 billion market cap. It's still 41 times earnings for a company like Planet Fitness. Very high return on invested capital, though. How many stores do they have? How many units do they have? They got United States, Puerto Rico, Canada, Panama, Mexico, and Australia. Interesting. Oh, they're also franchisors. Oh, I didn't know that. I didn't know Planet Fitnesses were franchises. Franchises. So guys, 4 checks, 4 X's. It's these metrics that drive me nuts. Even if they made $100 million a year permanently, it's still 41 times their market cap. And how can you justify 41 times their market cap unless you think they're going to have amazing growth potential, which they could, but you got to have really good growth potential. Let's go check out their the analyst estimates. All right, big growth in their earnings per share, but not going out very far. And revenue growth is double digits. Earnings growth is double digits. Pretty solid. Oh man, look at this revenue growth numbers though. Maybe it makes sense. Big revenue growth numbers. 5-year ROIC is high. Interesting. I'm just going to do a number of assumptions here. You can change it to 1, 2, or 3. I'm just going to do 2. I'm going to do 5 and 10% revenue growth. Profit margin, I'm going to do 9.5, 10.5. Free cash flow. God, free cash flow is so terrible. It's so much lower than their profit margin. Maybe it has to do with their growth. Let's just stick with 9.5 and 10.5. PE, 15. I'm going to go 14 and 17. Same with price of free cash flow. And for returns, I want 12.5 and 15. Because I don't like this free cash flow difference. I'm going to hit the analyze button. Oh yeah, I'm staying away from this thing. I have 15 and 25. And it kind of makes sense considering their current PE is 33. And it's based on high profit, the record profit. So is that sustainable? I don't know. All right. Local company, SJM, Smuckers, JM Smucker. This company has a terrible ROIC. These companies tend to have bad ROICs. The ones that made these food products, 6% over the last 5 years. They didn't make a lot of money. They lost money last year. High free cash flow. Look at this. 911, never forget, free cash flow in the last year. Earnings, they lost 17 million. 5-year average free cash flow, 877. 5-year net income, 552. So their free cash flow is actually higher than their net income. 14 price of free cash flow. They don't, and 14 5-year price of free cash flow and 23 5-year PE. Good guy. So guys, oh, look at this. Big dividends. 3.2%. And guess what? Guys, if you're new, don't fall for the dividend traps where they just pay a big dividend. You have to look at the dividends paid versus their 1-year and 5-year average free cash flow. They can afford this dividend. 430 million, their 5-year average free cash flow is 877. Let's go see what analysts are saying. So guys, before we do this, I want to show you, these are all the Smuckers brands. And I don't think this is fully their full list, but there's some big names here. Smuckers, Jif, Folgers, Dunkin' Donuts, Pillsbury, Crisco, Hungry Jack. But guys, these are big brands. And they're right down the street from us. They're half hour away, Tim? Yeah, so that's pretty awesome. And guys, they just acquired Hostess last week for $5.6 billion. Hostess is back, baby. It's going to be awesome. So, I mean, I don't know if it's going to be awesome, but the bottom line is, let's look at, they're $126 a share. There's not much growth in this earnings per share according to analysts. $8.78 this year, going to $10.56 in the next 4 years. All right, mid-high single digits, but look at this revenue drop. They're not expecting big stuff from the company. Lower revenue 4 years from now than they are today. So guys, this is a company that you got to get your money back from them buying back shares and paying you a dividend. So that's important here to do that with a stock analyzer tool. Sit here and figure out what is the right price to pay. Because look at the 8 pillars here. Man, just, ugh. I mean, this is appealing. Don't get me wrong. 14.5 times their 5-year free cash flow. Free cash flow's up. They've bought back about 9.5% of their shares. Terrible ROIC. Listen, to me, unless this is a stupidly low price, and a lot of people love dividends, and I see it on Twitter all the time, like, oh, dividends are the best, and I don't get me started on that one, but don't just buy this for the dividend. Make sure you're buying a company that you're okay with a bad ROIC and not a lot of growth. Because the only way you can increase your value as a shareholder is by them buying back cheap shares. That's how, what you want with a company that doesn't have a high ROIC, they can't invest the money at high rates of return. So they got to buy back their cheap shares. When people don't like the shares, they buy them back. As long as they can have a stable earnings per share, they can buy back a ton of shares and drive up that earnings per share. And when the earnings per share goes up, what happens to the stock price? It will eventually follow. So that's what applies here. So guys, thanks for looking at these 3 companies. And again, 7-day trial for free, full access, everything, community, all the tools. Go sign up now at the link below. Take care.